Hi guys, welcome to the second video for this course. Today we will be discussing the characteristics of assets and furthermore some types of assets like intangibles. So what are assets? An asset is defined as an account controlled by the entity that may result in economic benefit which is results from past events. So the three things to look at are the possible future economic benefit controlled by the entity and result of past events. If something does not pass these criteria, it is disclosed in the notes of financial statements. If it does pass, then we move on to the recognition criteria. So let's look at an example. If you buy a coffee, this doesn't really have any possible future economic benefit once you drink it. Perhaps maybe other than to quench your thirst. Once you buy it, you do have control of it, and it is a result of past event. The past event being when you actually bought the coffee. Being that it did not pass all three characteristics, it is not an asset and it is disclosed in the notes, but it could also perhaps be an expense. So now, recognizing assets. So, to be shown as an asset on the balance sheet, an asset must have the three characteristics we discussed last slide, and also have probable future economic benefit and the ability to be measured reliably. If it passes the characteristics but fails these two recognition criteria, or either one of them, it is shown as an expense in the income statement, or it can actually be shown in the notes as well. If it passes both, then it is recognized as an asset on the balance sheet. So let's use another example of a lottery ticket. So it does have the potential to bring future economic benefit, it is controlled by you, and it is the result of past events when you actually bought the ticket. So although when it comes to recognition though, it can be measured reliably, but there's no probable future economic benefit. So the chances of not winning are much larger than winning. Therefore, it is expressed as an expense. This is a possible treatment of a possible asset. It is what we have looked at the last couple slides. So, do the item have all the essential characteristics of an asset? Yes, then we see if it meets both the recognition criteria. Yes, it's recognized in the entity's balance sheet. No, details might appear in the annual report or disclosed in the notes. Capitalization, maybe a term you may or may have not heard of before. Capitalization is if something that is bought or gained is recorded as an asset. The amount paid for this capitalization is known as its cost. If it is recorded as an expense from not passing recognition criteria, it is not capitalized. The amount for this expense is known as the expenditure. Now let's look at a strange type of assets. These are intangible assets. These are identifiable, non-monetary, meaning not cash, assets, without physical substance. So you can't really touch them. Like copyrights or trademarks. People think that these do not make much sense because they do not think it can be measured reliably. Well, first of all, these assets must meet the characteristics of assets, and buying these from someone else will have a price, and therefore can be measured reliably. But now for the internally generated intangibles. Well, the internally generated intangibles are things the company does that benefit the company that they didn't actually buy from anyone, and they have no money value. So what this would include is research or development. Okay, so research accounts, like the research phase in looking at chemicals or testing for cures in a science industry, are always expensed, so they're never capitalized. For the development phase, we must look at the recognition criteria to see if the asset can be recognized. So this is if it has probable future economic benefit and if it can be measured reliably. So goodwill's probably the weirdest type of asset. It's not identifiable and is the value over its separable identifiable net assets. This is pretty much also its worth of equity. As it is not identifiable, we can only recognize purchased goodwill. So that's from another entity, but not when it's internally generated from our own company. So depreciation. So you would have seen this all through Accounting 1A. and we actually look at an expense. So no, it's not an asset, but it's in our asset week video. Depreciation is if it decreases the carrying amount of a non-current asset. It's the process of systematically allocating the cost over the useful life of the asset. So this can actually be done in 3 ways, which were all discussed in Accounting 1A, but in case you forget it, we're going to go through them and we'll do an example for each one. Straight line method is equal depreciation every year. So example, if there is a vehicle worth $100,000 and is used for its useful life for 9 years, when it reaches its salvage value or selling price of $10,000. Therefore, we would calculate the depreciation for each year as 100,000 minus 10,000, which equals 90,000, divided by 9. So it would be $10,000 depreciation every year. Every year the same. So 10,000 every single year. Okay. Moving on to the reducing balance method. Okay, a certain percentage of the carrying amount. So example, the same vehicle that we looked at before, $100,000, but this time has a reducing balance of 20% per year. So this actually changes the amount of depreciation every year. So the first year is 20% of $100,000, which is $20,000, and then the next year the depreciation will be 20% on the carrying amount. So the 20% on the carrying amount is 20% on $80,000 and is worth $16,000. Units of use is based on the use of something. So example is like driving a truck, which has to do with a certain amount of driving in 1 year. But this will actually never be tested in Accounting 1B, so no need to look at that. That is for that. So let's look at a summary for this week. Assets must meet 3 essential characteristics and 2 recognition criteria to be capitalized in the balance sheet. Intangible assets are way more difficult to deal with, like internally generated assets and goodwill. And lastly, depreciation is reducing the amount of an asset through accumulated depreciation. So something is usually worth less over time. So guys, I hope this has helped, and next week we are looking at the second part of assets.